It's set to be another bouncy week for investors, racked with worry about Eurozone debt. But the weekend in Washington may have produced some promise. The annual meeting of the International Monetary Fund was attended by Eurozone leaders. It was no time for small talk.
We are in a precarious situation. We face a confluence of sovereign debt and banking risks.
But there was clearly a common recognition, a common diagnosis of what is happening at the moment.
With Greece on the brink of default and market confidence shrinking ever further, there emerged the bones of a plan. A possible final solution could look something like this. Greece, the Eurozone's core problem, would be allowed to default, with 50% shaved off the value of its debt. Europe's banks that own much of that debt would have to be recapitalised to help sustain their losses. And Europe's bailout fund, the EFSF, would borrow against the capital it holds, increasing its protective financial firepower to the tune of trillions of dollars. The plan represents the sort of radical move markets have wanted to see, but it's far from foolproof, far from a done deal.
I think quite clearly what markets want to see is a degree of unanimity within Europe, and I think the real plan that Europe would have, or that the markets would have liked to have seen, would be these Eurozone bonds backed by Germany, good, safe alternative to Greek sovereign debt and even Spanish and Italian sovereign debt. That's hugely unpopular in Germany, and it's unlikely. Still, we're not seeing that come out of these discussions.
The markets may take heart. There is at least a sense now that leaders appreciate the size of the problem. But political divisions could yet scupper a deal. On Tuesday, the Greek Prime Minister visits Berlin, hoping to secure the latest slice of bailout money. But with Greece struggling to meet its commitments, default could yet come before the system is in any way ready for it. Jonah, Al Jazeera, London.